We got a lot of things going on today. Ulta Beauty on the forefront here. Nice pop in all the indices. S&P up over 1%, Dow up over 1%, NASDAQ up nearly 2%, Russell up 2%, crude oil 1.5%, and gold 0.5%, with Ulta Beauty being in the forefront now that Warren Buffett has taken a position in this undervalued company. This is one we were actually looking at on a lot of the live streams, but in today's video, we're going to touch on my largest position. And that's going to be the nearly 8% move in Cisco Systems, ticker symbol CSCO. This one has been in a downtrend for about 3 years, pretty much dead money for 5 years, and still down 9% over the last 12 months. Now, I think this was a pretty confusing earnings report. I think there was enough for the bulls to chew on. I think there was enough for the bears to chew on. So I want to go over exactly what I'm personally seeing, what I like, what I don't like, and just give it to you as I always do, guys. As always, this is just my opinion, not financial advice. Now, I don't want to get too excited on this move because the last time they reported earnings, the stock shot up from $45 all the way up to $52 and then sold off the week after, basically getting right back down to $45. Very, very frustrating stock, and I think we could see the same thing coming once again because Q1 of next year is going to be a little bit light here. What I want to do is just point out exactly where I have my analysis on them. I basically think between $44 to $35 is where you need to be accumulating shares here, and you've had the opportunity to kind of get in that $44 to $45 range pretty consistently on a lot of the dips for Cisco Systems. So let's go through the earnings together here. I'm going to point out pros and cons. Obviously, the product growth of 14% year over year is extremely positive because we know that the product growth was something lagging. They're giving market share away from Arista, they're giving market share to Juniper, and so there is some market share being taken away from Cisco Systems, but the business has been slowly shifting and we're starting to see that positivity come through on earnings. They hit revenue on the higher end of guidance, which was beating expectations both from an EPS standpoint and a revenue standpoint, so it was a double beat, and that's why we're seeing nearly an 8% move. But I want to reiterate, we're seeing an 8% move off of 52-week lows. So just keep that in the back of your mind. Now, here's where I get really, really excited about the company. Subscription revenues are now making up $27.4 billion, and that's including the Splunk acquisition, which is now making up 51% of their revenue. So a majority of their revenue is subscription-based, that reoccurring revenue that's going to be taking place. And that's huge to see, with software revenue now jumping up 9%. What does this mean? This means that software revenue is going to grow margins, and it's going to be and it's most likely going to be a reoccurring revenue we're going to see. So that 51% subscription revenue growth and that reoccurring revenue growth within their business model is something that's going to steadily grow here, and that's where we get multiple expansion on the stock. We're dealing with higher margins, we're dealing with more predictable earnings going into the future, and we're not as reliant on a lot of the hardware selling that takes place with Cisco. They're starting to get a nice balance here and showing that they're implementing this balance, but there's still some problems. With all this positive news, revenue decreased 10% year over year. Earnings per share came in on a GAAP basis at 54 cents and from a non-GAAP basis 87 cents. This is a company that hasn't been able to really grow earnings. They're buying back stock, they're paying dividends, but they're not growing their earnings. They're basically staying between 87 to roughly 90 cents a share of earnings. And where's the big problem coming in? For Q1 2025, on a GAAP basis, they're looking to do 35 to 42 cents of earnings. So when we're comparing quarter over quarter, this is where the problem's going to come in. Earnings were 54 cents on a GAAP basis and 87 cents on a non-GAAP basis. But if we go to Q1 next year, they're only projected to do between 35 to 42 cents on a GAAP basis and still be within that 87 cents once again from a non-GAAP basis. So we're not seeing earnings accelerate. And I've said this before, this is going to be a 3 to 5 year story. We're going to see those earnings accelerate if they keep buying back stock, they keep growing the margins, and they get more of that subscription revenue and annualized recurring revenue on their balance sheet. That's going to absolutely force the stock to go in an upward direction. And I think the market's seeing that. But what I wanted to highlight is there's going to be a slight growth in top line revenue for full year 2025, but first quarter of 2025 I think is going to be a little bit dicey here. They're basically just doing a little bit above what they did in Q4 of this year, but the earnings are going to be a little bit weaker. And basically what I'm trying to say here is that going to keep the stock kind of range bound until we really see more progress come through on total earnings. Now, the nice thing is they did give us what they project full year 2025 guidance to be. And so when we look at it from a gap basis and we just meet in the middle and say that they're going to do pretty darn close to $2 a share from a gap basis, and they're basically trading right around $49 a share. We divide that by the $2 a share. From a gap basis, they're going to be trading at 24.5 times earnings, which is not a real screaming deal for a company that's growing revenue slightly and earnings are kind of remaining stagnant. Now, if we look at it from a non-gap basis and we meet in the middle and say they're going to do right around $3.55, we take that $49 divided by 3.55, and we get right around 14 times earnings, which is historically what they've traded for. So I'm not seeing any rush to this stock. I think if it's trading between $40 and $50, you're probably sitting right around fair market value. I call it $44 and below to the high 30s, maybe mid 30s. That's where I really think the stock gets even more interesting. So I'm going to steadfast on the stock right now. I think they're doing everything that I personally like. I think they're really shifting their business model in the right amount of time. I think they do have some AI exposure. They're doing a lot of creative things with $1 billion into an AI fund, acquisition of Splunk. They have the hardware and software side working nicely together. Overall, I think the business is becoming more insulated, but I think there's some problems going ahead. They also have right around 7% of layoffs coming next year, which is going to impact the first few quarters of earnings. So as we get into next year, just keep in the back of your mind that earnings are probably going to look a little rough because they have to give severance packages. They're still taking hits on the Splunk acquisition. But going into the end of 2025, we're probably going to see those earnings start picking up because they're not going to be taking off as many, because they're not going to be taking on as many write-offs. And they also should be leaning out the business, which means there should be more free cash flow generation and should be stronger earnings growth in the future. Of course, this is just my opinion, guys. Wanted to dive into Cisco. So right now it's steadfast. I think it's at fair market value between that $44 to $50 price target. And I think if you get below $44 a share, you really have to start looking at the stock longer term with that nice dividend yield, buying back stock. And it looks like they really are getting the SaaS side of the business growing. As always, guys, really appreciate your time. We will see you in the next one.